All right, let's talk about all this with Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, it's great to see you. So let's start with Treasury Secretary Janet Yellen's comments. She was pretty positive, saying that a recession isn't a sure thing. What do you think?
No, it's pretty assured, I think. In fact, if you take a look at a lot of the data, it is already pointing to probably we are already in maybe a mild recession. It's a little different than what we're used to, right? In 2020 and 2008 and 2009, they are what I'd call the everything everywhere all at once recessions. Everything was going down at the same time. It was obvious. And they began to rebound at the same time. This is very different. We're calling it a rolling recession. Right now, manufacturing is in a recession thanks to burgeoning inventories and slumping retail sales. But at the same time, the service sector is doing well. Just try and book an airline ticket or get a restaurant reservation. You can see that. So we're rolling through different parts of the economy in recession at different times. I think overall, economic growth is soft and pointing to at least a mild recession. And I think that's already in the cards. The question is, when does a recovery begin to form? And it's hard to see that happening before the Fed stops hiking interest rates.
And Jeff, we're still trying to figure out when the worst is over, I think, and maybe that's maybe some light can be shed on that tomorrow morning with that CPI print. Somewhat unusual that we're getting such a huge data print the day of an actual Fed meeting, at least when it's set to begin. And just thinking about that Nick Timiraos article that I was talking about that was released earlier today, how different should we expect this FOMC, and it has been different so far this year, but especially next year as we approach with the greater likelihood of a recession. And meanwhile, the Fed's trying to hit everybody on top of the head saying, look, our response is going to be very hawkish. You shouldn't expect surprises when we're telling you exactly what we're going to do ahead of time. At least that's the message I'm getting.
Yeah, well, here's, one of the things that happened earlier this year that really threw the Fed for a loop and certainly caused them to abandon transitory was that war in Ukraine by Russia. It certainly pushed up prices that were already elevated, pushed them up even further. It created a crisis, and they were forced to act to that, to aggressively tamp down inflation. I think the maybe unanticipated event, or the event that they're maybe not focused on, is the fact that while they're trying to step down interest rate hikes, China is stepping up their reopening. Remember, this is 1.4 billion consumers, the largest middle class in the world. They have pent up demand. Their cash flow, their deposits are high. Their mortgage rates have been falling, the opposite of everywhere else. That pent up demand could be unleashed in the coming, not just months, but maybe weeks. And we could start to see goods prices and commodity prices begin to rebound. Oil's up 3% today. Could that lead to a resurgence in some of the inflation pressures that the Fed wants to avoid? That could be the dominant factor as we look out to the next few Fed meetings, much more so than our own CPI.
Jeffrey, when it comes to what the Fed is going to accept, Mohamed El-Erian, he had an op-ed in the Financial Times today talking about that the Fed might stick with this 2% inflation target, but in fact, they're going to settle for something higher. Do you think the Fed will be comfortable settling for 3-4%, potentially even higher than that?
Well, the Fed has been consistent in its view that around 3% is a threshold for long-term inflation expectations it's uncomfortable with. So if consumer expectations remain anchored between 2 or 3, even if they're at the high end towards 3, I think they can be comfortable with CPI being higher than that as it maybe trends lower over a longer period of time. I don't think they have to hit that 2% or even get close to it by the end of the year, but they do need to keep those longer-term inflation expectations anchored. We did see that in the recent University of Michigan numbers. They're right at that 3% threshold. They don't want to see those go any higher. I think that's the bigger factor. The Fed has always talked about those expectations being more important than the current rate of inflation.
And how are you seeing this translate maybe into opportunities for investors? Where are you, or where would you put your money right now, or recommend that to clients?
So I'm really excited with what I'm seeing outside the U.S. In fact, Europe has seen the best quarter of stock market performance ever in the entire history of the Eurozone. This fourth quarter here, 25% gain, the best we've ever seen. And we're seeing in Europe more of the stocks that are outperforming in the US, meaning those with higher dividend yields and lower price to free cash flow ratios. I call those quality stocks. There are more of those represented in those European benchmarks, and they're doing so well. I'd also focus on the fact that what we're seeing in international markets is lower valuations, better earnings growth prospects for next year. All of this combining, I think, to create an environment where we'll see another year of international stock market outperformance. Despite the rise in the dollar this year, international stocks outperformed. I think we're at a turning point for this coming cycle of international outperformance. So I would focus there, an area of portfolios where many investors have neglected over the last decade, given U.S. leadership. That could be changing.
Certainly sounds like you're seeing a lot of opportunity overseas, but bringing it back here to the U.S., I know you like international versus domestic, but are you seeing any investment opportunity when it comes to the U.S.?
Yeah, so focusing again on high dividend payers, this is an area where even within sectors you don't normally think of looking for dividends. In the tech sector, we're seeing the best dividend payers, the highest dividend payers, outperform the rest of the sector by a wide margin. It's true really across the board in every sector, in every country, and that's a theme I think that may continue here as we see companies. Yes, we're in a recession, but it's not one that's likely to dramatically weaken the cash positions of companies, which have really built up over recent years. So I think they'll sustain those dividends. That'll be something investors continue to focus on. So I think you don't need to think about sectors from an investment perspective. Think about characteristics or factors like high dividend yields and focus your investments on those.
And maybe strong balance sheets as well, just to go show there are still some winners, potential winners inside the U.S. markets here. Jeffrey Kleintop, thank you as always.